A lot can happen to our portfolio over periods of time. Recessions happen, market crashes occur, and investors can lose a lot of money. For example, in 2008, investors lost over 50% of their money in just a year. Imagine that. One day you think you have all of this money in your portfolio, and then you come back 1 year later from a long holiday and you've lost half of your money. Well, this is why it's so important to ensure that our portfolio is prepared for all market conditions, because we never know what will happen in the stock market. So the question is, well, how do we prepare our portfolio for a stock market crash? Well, one of the greatest investors of all time, a guy by the name of Ray Dalio, has already answered this question. A couple of years ago, he came out and shared with the world his all-weather portfolio. What I want to do with this video is go over that all-weather portfolio for you and look at each individual part to it and see why it performs so well in all market conditions, but especially in market crashes. Okay, so this graph right here shows you the return that the all-weather portfolio has gotten over time. Now, the interesting thing was that while all stocks were crashing starting October 2007, the all-weather portfolio actually started going up. Remember, from October 2007 to March 2009, the overall US stock market crashed 55%. Ray Dalio's portfolio only went down slightly a couple of percentage points over that same period. So while everyone else in the stock market had lost more than half of their money, Ray Dalio was smiling along because he had prepared his portfolio for a crash. You know, even if we look at the worst drawdowns that Ray Dalio has ever had with his portfolio, they have been pretty minimal. The worst ever has been only 6.9%, and this recovered in just 6 months anyway. I think we can all deal with the 6.9% drawdown. If we can't, perhaps we should be thinking about not investing at all. So I just want to give credit to this website called LazyPortfolioETF.com because they were the ones that made this graph here, helping me be lazy and not create it myself. So this is Ray Dalio's all-weather portfolio, and I'm just going to say now that at the end of this video, I'm going to give you some really interesting insights into the overall return of this portfolio long term. So stay tuned for that. But we're going to start with the asset that I like to own the most, the asset which Warren Buffett also likes to own the most, and that is stocks. The all-weather portfolio has just 30% of it in stocks, and the stock that they own is an ETF under the ticker symbol VTI. VTI is just a total stock market ETF that seeks to track the performance of the US total market. They do large, mid-cap, and small-cap stocks diversified across growth and value styles. The fund is fully invested in the stock market with a really low expense ratio of 0.03%. If we look into the performance of this ETF, it has been Ray Dalio's best performing part of his portfolio by far. If you invested $10,000 in 2009 into this ETF, that would be worth pretty much $40,000 today. A 300% return in just 10 years. That is crazy good. If we look at the 10 largest holdings of this ETF, it's pretty much what you would expect. It's got the likes of Microsoft, Apple, Amazon, Facebook, Google, Berkshire Hathaway. It's got a bit of J&J in there, a nice dividend stock. It's got JP Morgan, the bank, ExxonMobil, and Visa. But going back to this fund's performance, which is really good, a lot of people would argue that Dalio should have had more than 30% of his portfolio in this ETF. And I would say he definitely should have owned more stocks during this period, which is one of the reasons why I like Buffett, because he knows the power of owning stocks, owning businesses. But remember this, everyone, the all-weather portfolio is for all market conditions, especially for market crashes. So it performs best relative to most when the stock market is performing poorly. Anyway, let's move on to what else is in the portfolio. Okay, so what makes up the majority of Ray Dalio's portfolio is fixed income. So his fixed income is through long-term US bonds and intermediate-term US bonds, And this is fixed income because bonds are just investments which pay you a fixed amount of interest on your investment every year. So 40% of Dalio's portfolio is in a bond that goes under the ticker symbol TLT. So TLT is simply a bond ETF which tracks bonds issued by the US government, and these bonds have maturity of 20 years or more. They're extremely long-term bonds, and you're going to get a yield to maturity of around 2.55%. So the thing with treasury bonds is you're guaranteed to get paid no matter what the stock market is doing. And it is one of the big reasons why Dalio performs so well in a crash, because these payments are guaranteed by the US governments. Then you've got the intermediate term bonds under the ticker symbol IEI, which are just shorter term bonds with yields to maturity of 3 to 7 years. But they also pay less of a yield compared to the other bonds at 2.06%. Okay, then we've got 15% of Dalio's portfolio that is in commodities. 7.5% of that is in the commodity gold. Ray Dalio, he owns gold as a store of value because gold has symbolized value for thousands of years. And as a portfolio diversification. He says this, he says, we have a situation now where we have too much debt. Too much debt leads to the printing of money, so all of those things mean that some portion of our portfolio should be in gold. Because often gold's price follows the amount of money in the system, so obviously increased money printing can increase the price of gold dramatically, and they often print money in and after a stock market crash. So Ray Dalio simply has his gold in an ETF under the ticker symbol GLD. GLD is the largest ETF to invest in physical gold and tracks the gold spot price using gold bars held in London vaults. Interesting. And the final part to Dalio's portfolio is a more general commodities ETF under the ticker symbol GSG. GSG tracks a version of the S&P GSCI, so basically it is exposed to as many commodities as possible. The GSCI tracks 24 different commodities from all commodity sectors: energy products, industrial metals, agricultural products, livestock products, and precious metals. So this ETF tracks a range of commodities. However, the ETF is a bit more expensive than most, as it has an expense ratio of 0.8%, but it does give you exposure to a range of commodities, so, at least Dalio thinks it's worth it. And that is what Ray Dalio's very famous and very popular all-weather portfolio looks like. Now hang on a bit, because we're going to talk about the performance of Dalio's portfolio in a minute, and I'm going to show you why I prefer a different strategy when it comes to my portfolio. But yeah, essentially his portfolio is 7.5% in gold, 7.5% in commodities, then you've got 55% in bonds, which I know Buffett would look down upon, and you've only got 30% in stocks, which is the main reason why the portfolio has not performed as well as someone like Buffett in the long term. Because you think about it, what are stocks? Stocks are businesses, and over the long term, stocks are going to produce items and make money. Make the shareholders money. That's the main point of stocks. So stocks over the long term are the better asset to own out of bonds or commodities. Ask Buffett and he will tell you the exact same thing. Now, I just want to finish this thing off with looking at the overall return of Ray Dalio's portfolio. So if we look at this, okay, this section says capital growth and historical returns. It says an investment of $1,000 since January 2007 now would be worth $2,282 with a total return of 128.23%. That is only 6.82% annualized. Okay, so if we compare this to something like the Vanguard S&P 500, the Vanguard S&P 500 got a 14.7% return over the last 10 years. Ray Dalio, he only got a 6.82%. If we compare it to someone like Warren Buffett, you can see Warren Buffett, since he's been investing, since he's made Berkshire Hathaway, he's generated a return of 20.9%. Over that, like 50 years. So Ray Dalio, over the long term, he doesn't have the best track record of getting high returns. What he does have is he's got an amazing track record of, okay, performing well in stock market crashes and getting stable returns that are trustworthy, that you can bank on. So basically, if you think there's going to be a stock market crash in the next couple of years, you may want to look at, a certain strategy to Ray Dalio, because you know that his portfolio does well in stock market crashes. If you ask me, I personally prefer a different tactic to prepare for a market crash. I definitely would like my portfolio, and do have my portfolio, in a lot more stocks compared to just the 30% owned by Ray Dalio. Owning stocks over the long term, it's a powerful thing. Buffett says the exact same thing. Stocks are there to make money, and that's why I personally prefer to have a lot more than 30% in stocks. And then I've got other market hedges, like I own gold and I own cash equivalents, which, Warren Buffett, that's what he does. He owns cash equivalents so that when stocks crash, he can keep buying more when they are cheap. So that's, another way around preparing for a market crash. And you can also own some dividend stocks, because dividend stocks, if they have strong balance sheets, they will keep paying dividends in periods of market crashes, and then you can still use that money to buy stocks when they are cheaper. So there's a couple of other tactics you may want to look deeper into. Or you can just employ Ray Dalio's portfolio for returns that are trustworthy, that are stable, and for returns in a stock market crash where most people will lose a lot of money, your portfolio will remain stable.